welcome to a special show where we are going to be focusing on some trading trends. Surbhi is here. She's standing by at the big wall with a roundup of some interesting details on investor behavior of late. Surbhi, tell us more. What's the recent month been like?
Well, the March data is really throwing up some pretty interesting numbers. And this is data from exchanges and depositories that is actually coming up with these interesting behavioral trends, if I could say. First of all, the trend of new Demat account openings is slowing down. Though the total number of Demat accounts at an aggregate absolute level continues to rise, the incremental new account addition, the pace of new accounts that are opening, that is what is seeing a drop. March saw 19 lakh new Demat accounts being opened as opposed to 21 lakhs in February. The March number is also well below the monthly average of 29 lakh Demat account openings that we saw throughout the last financial year. So 2022, if you average out 12 months, the average monthly run rate was 29 lakhs. And in March, it's come down to 19 lakhs, March of 23. Now, lackluster markets are probably one of the key factors behind this drop in fresh Demat openings. And that could also be a reason behind the steady decline seen in NSE's total active client base, which has been falling for 9 consecutive months. It's in fact come down to 326 lakh accounts in March. Mind you, even though the number of NSE active clients is down almost 9.5% in March 23 versus March 22, discount brokers aren't complaining at all because their collective share, it's been growing steadily through the last 1 year and now it stands at over 60%. I'm talking about the top 5 brokers, that is Zerodha, Upstocks, Angel One, Grow and 5 Paisa Capital, and they're making up for 60% of the market share now. Let's move to another very, very interesting trend when it comes to retail participants, retail investors, or maybe I should say retail traders now. Now, their increasing interest in the futures and options market is something that you can't ignore. Let's look at the basic turnover trends to begin with. Despite the market remaining flat over the last 18 months, average turnover has been fairly healthy. In fact, the daily turnover in March is up 146% over the same period last year. So March to March is the comparison that we're looking at. And this is courtesy the rise in F&O volumes. Average daily turnover in the F&O segment is up a whopping 148%. Again, I'm comparing March of last year to March of this year. Now, it's not just the seasoned investors, really, or traders that are active in the F&O market. Retail has decided that it doesn't want to miss out on the F&O opportunity either. Motilal Oswal points out that retail segment average daily turnover has grown about 12.5% month on month. That's March versus February. But the more staggering, stunning comparison is actually on a year-on-year basis. Look at the trends. March of 22, this is average daily turnover in the F&O retail segment. It was at 40 lakh crores. It's jumped all the way to 87 lakh crores in March of 23. Cash market retail volumes actually have dropped in the same period by a little over 28% to 237 lakh crores. So there you have it, becoming very, very clear that retail investors want to experiment with newer ways of making money, and they seem to be heading from the cash to the F&O markets. Well, that's what the data is really throwing up, what the numbers are throwing up. But what is the investor psyche all about? Is the retail investor just frustrated with this market not going anywhere in the last year and a half? Well, who better than A. Balasubramanian, chairman of AMFI, and also, of course, MD and CEO of Aditya, Birla Sun Life AMC, to put that question to. Bala, thank you for joining in. So I guess it's a fact that, we can't shy away from, right? A lot of retail investors, especially the younger lot, the newer investors who came in after the pandemic, perhaps they got used to very quick returns, which isn't happening. What is your sense? What is the pulse of the retail investor telling you?
So I think the way I look at it on a big picture basis, I think post-pandemic, as well as during the LIC IPO when it happened, the number of Demat account got opened was growing up quite significantly. And this was one of the segments where we're all concerned that Demat account opening in the country has not been growing as much as it should be. Therefore, that began that had some kind of push. And during the period of pandemic, given the fact that markets were doing pretty well, most of the people felt that trading the market directly, I'll make more money instead of coming through mutual fund and other things. Though mutual fund continued to grow on the other side, but people trading in the equity market directly also went up quite sharply. But during the volatility, especially if you look at the last 1 year, there has been an increased level of volatility. Global markets have not gone anywhere. There has been a significant fall that we have seen in the ITS sector compared to the other sector in the last 1 year, including Nasdaq stocks. I think people actually generally tend to withdraw. The people who actually came and tested the water during the good period, they actually tend to withdraw from trading point of view. I think the way I've seen people are withdrawing on the F&O market. F&O market has, even by SEBI done an analysis, 80% of the traders in F&O market are losing money.
90%. I remember that statistic. They put it out in January saying 90% of active F&O traders have lost money in 2022. Despite that, we're seeing this increase in retail activity in F&O.
Exactly.
Are you worried? Does it worry you?
I think it's of course, everyone has to experiment the market. People have to lose money for learning, increase the learning curve. No, absolutely no issues. But I'm not worried as such because the drop in demand account and increase in F&O volume, I'm not so much worried because today the margining systems, I think the exchange that you have built in is quite robust. I think the earlier occasions, and I'm talking about, say, about 20 years back or 15 years back, increase in trading volume in the F&O market or maybe in the futures market would actually make people worry because it can lead to systemic risk. And the exchange and default risk could come or settlement risk could come. And today that thing actually got protected. From investors' point of view, the more, of course, the trade they do actually in F&O market, the naturally, of course, they lose money. They are saving, of course, it comes out of the savings. And those are earning member, of course, it's fine, you can sustain it. If you're not earning member, then actually lose your money permanently. Therefore, that's something that makes me worry. And but I'm sure this kind of cycle we see in every market. And whenever you see a bull market become bear market or bear market become bull market, we always see some kind of retail investors getting stuck. But that doesn't mean that that's something one should worry about it, given the fact the last few years the learning curve of people has gone up, understanding has been going up quite significantly, and therefore any retail participant is coming on the basis of certain informed decision that they do take as well.
You know, another analyst pointed out another interesting piece of data. This is, of course, research from HDFC Securities. I'm just quoting their data. And they pointed out how the ownership, retail investor ownership of NSE 100 companies, that actually went up in COVID because more and more people were coming in through mutual funds, through direct equity. But now incrementally, apparently in the last, I think, year or so, it's seen a marginal dip, just a 50 basis points dip. Again, now these could be trends and aberrations here and there. But going forward, what is the expectation that you have? Monthly inflows into funds continue to be pretty robust. The SIP numbers are pretty robust. But on the equity side, with returns not coming in, will this year throw up a challenge?
So I think every 2-3 years we see with the good year followed the bad year followed the good year. And one good thing that has happened is I think incremental understanding of investing for the long term have been rising. And the SIP way of investing now is becoming the way of investing for investors. Even the people who have been participating in the equity market directly, they also now know what kind of risk actually is involved while trading in the market. Therefore, what kind of risk control mechanism I will take. That also is rising. And given the fact that we are, of course, heading towards a $5 trillion economy, I would only assume the rate of pace may actually come down a little bit, but level of interest I think will stay constant. The level of interest, participating interest will remain constant. I think mutual funds, a vehicle to be used for the purpose of savings for the long term, I think will gain more and more prominence. And given the fact, as you rightly mentioned about people are losing money in the fund market, the same set of people had they come into the equity market through the mutual fund, through the SIPs, despite equity market not giving good returns for the last 1 year, and returns would be in the range of about 4 to 5%. Because the rupee cost averaging that actually takes care of your market fluctuations, probably they would have been better off. I think there are many investors who realize this. If I invested in a mutual fund over a period of time through the SIP, I would have probably made really better money. I'm not saying more money. At least you would have made at least some money which will actually keep you satisfied. And that realization definitely is coming. Therefore, trend-wise, I would assume that that I think will only remain somewhat buoyant. But given the fact
so
that
you're expecting flows to remain buoyant?
Yeah, flows to remain buoyant. Of course, there will be some marginal dip. Flow will come. Whenever I've seen historically, whenever the 1 year and 2 year returns become relatively weaker, there are people, I call them fence sitters. A lot of the fence sitters who come into the market with the less convictions, tolerance levels are very, very low, do not have the long-term visions, and they generally tend to move off and then they come back. I have seen such kind of people, they only realize later that I should have stuck to my investment, stayed put on my investment for long term or continue my investment for long term. And that kind of people also have realized in the past, after 2008 crisis, I have seen many people repending, cancelling their SIPs, moving away from the equity market. and then come back in 2014 when the market started turning bullish market.
Well, I guess a rising market does end up attracting people, though I know wisdom on personal finance and investing suggests that we should do the reverse, right? Invest more when the market's down. But I want to sort of, get you to wear your business hat now as AMFI chairman and, of course, the CEO as well. The going for mutual fund companies, that's also getting a little tougher, right? There's a lot of talk about regulation as we are going forward in this year. On total expense ratios, for instance, I think now a lot of costs like GST, brokerage, all of that is supposed to be a part of TERs. Are you expecting anything additional from SEBI in terms of regulation in the near future?
I think we must look at some changes, of course, might come this year, given the fact that I think regulator has got some stated objective. As the volume starts picking up, as the market becomes bigger and bigger, as the players become larger and larger, and once he reaches scale player, I think they seem to have the opinion that scale player benefit should go to the investors by way of making the marginal adjustment on the expenses. But as it is, I think even the earlier, whenever they brought in changes in the overall expense structure, they always said that after 3 years they will review upon seeing some kind of volume growth, etc., and so on and so forth. Therefore, there is a constant engagement that, of course, SEBI does, and with the industry players, with other market players, and see actually what best I think incremental can be done in the interest of investors. So
last time, I think the major TER overhaul when it happened was, I think, back in 2018?
No, it was in 2012, then it happened in 2016, then it happened in 2019 or 18, and now they are saying it at 2023. And
so is there a possibility that expense ratios might be capped even further? And could that be a serious challenge and crimp the industry growth?
See, I think it's about the way I look at it. Of course, they are looking at rationalizing it further, and what will come finally out of the which would not at this point of time. And also, given the fact they have also recognized that the mutual fund is the only industry given actually the biggest level of comfort in the equity market, especially at the time, $20 billion of FIs have taken away money in the last 1.5 years.
Yes.
FIs have completely been out from the equity market in India, and mutual fund industry has been the single largest buyer in the Indian equity market. They are given the most stability in the Indian equity capital market. Given the importance the mutual funds are playing, I'm sure even the regulator will be sensible of will understand far more better in terms of to what extent one must reduce the expenses, given the fact that mutual fund will continue to play a larger role and mutual fund penetration continues to remain very, very still low compared to the global market. Therefore, given the need for growth and also given the steps that they have to take for interest of investors, I'm sure they will do a fine balance between these two.
Okay, all right. Well, good to see you sound as optimistic as ever. Thank you very much for dropping by and helping us make sense of some of these, trends in the shifting sands, perhaps, in terms of retail investor movement and appetite towards markets, whether it's direct equity or through the mutual fund route. Thank you for stepping in, Bala.
Yeah, thank you, Sarvi.
Okay, well, on that note, we do have to take a very quick break. On the other side, we continue with this conversation and get you some more views on this trend of the rise of retail investors or retail traders in the futures and options market.
Yes, 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 yes. Quiet! It's okay for us to nod for everything, because we are parrots. But your wealth manager?
Zedlac Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
100% happiness with SBI Home Loans. Zero processing fee at 8.50% onwards. Apply today. Call 1800112018. Visit homeloans.sbi.
Welcome back. So we just heard from Balasubramanian, but earlier we caught up with Sandeep Bhardwaj, the COO and CDO of HDFC Securities, on the same theme, retail investors taking a lot of interest in the F&O market, even though the overall pace of increase in demat account openings is declining. Let's take a look at this conversation.
Largely number you have already shared, from demat, new account demat participation, from ADTO participation, derivative, we already seen over 100% growth in retail turnover. The market, which is over 40, has already moved over 80 lakh crore. And on a cash side, if you look at the cash side, which was 33,000 crores, has come down to 23,000 crores. And I'm talking about retail cash participation. Now, let's look at what's happening in terms of customers holding. how customers are holding, one interesting number which I want to share, which that retail ownership of NSE listed universe has declined from 16-18% from 2001, 2002 to 8-9% in 22. It means the total market capitalization of NSE listed company retail only holds 8-9%. Vis-a-vis what has happened during the COVID, this 8% grew to close to 10%, which we are again seeing a decline of 52 basis point by financial year 23. So ownership level, other than turnover basis, ownership level also, we are seeing a downtrend in terms of people holding that. And let's look at why people, trades in derivative, because it's in various forums, it has been talked about the derivative turnover is growing. But why people trade in derivative? Today, if you look at
Sandeep,
Nifty,
before, if you could just allow me to come in, because you mentioned a very important point in terms of ownership. I think you mentioned NSE 100, right? You said ownership in terms of retail investors owning these companies, it went up to about 10% in COVID, and now it's come down 56 basis points.
Yes. So if you look at 2001, when it used to be
Sandeep, what I'm trying to understand is that while COVID, obviously, it's a no-brainer, right? People were sitting at home and they were coming to equities directly. There was a lot of direct stock picking happening, but SIP numbers are still very strong. So retail investors are still investing through mutual funds. Then what accounts for this decline in ownership of NSE 100 companies by the retail segment?
See, if you look at the SIP number, month on month, it has already reached 14,000 crore, close to 14,000 crore. So it's like a tactical shift of retail participating in indirect equity. In direct equity, from a stock point of view, it is always a pain for retail customers to choose, pick and choose stock. And it also emotional where people end up booking losses or profit quickly. Vis-a-vis in mutual fund SIP, it is a long-term instrument. People are stick to in terms of their behavior. So I would say it is a shift. It's a tactical shift in from direct equities to mutual fund way of investing. And as far as ownership is concerned, we saw, I think from 2001 till 2019, it was a constant decline in terms of ownership of NSE listed companies. But during COVID, when we saw close to 2% of the ownership high, which again we are noticing that it has already down by 0.6 basis point.
So this retail ownership number of 10% that we are currently at, close to that, that takes into account the SIP numbers, right? This is not just direct investment into.
Yeah, this is mutual fund investing also. Yeah.
This includes that, and despite that, we are seeing a drop in the overall equity participation and ownership.
I'll give you another interesting point. So retail investors was net buyers in 2020. They bought close to 500 million. That happened after 11 long years. The net buying before that came in 2001. Post that net buying came in 2020. We have always looked at mutual fund net buying versus net selling. But when you look at retail, this has happened after 11 long years. And between 20 to 22, then they invested close to 2.79 trillion in NSE capital market. But when we look at current December last quarter 2022, we have seen again 1.42 billion of selling happening out of it. It means the people are either a profit booking or they are booking losses. They are moving out of retail equities.
Okay, got that. Sandeep, let me come to you on the F&O figures as well that Surbhi was talking about, right? We're seeing some big numbers there, and perhaps this money in a market which is just moving sideways is now moving to F&O in hopes of perhaps better returns over there. Take us through what else you're picking up, and is this, considering that we have been talking about the fact that this entire year is likely to be like that, we're not likely to see much in terms of a gain. Do you think this is a trend that's likely to continue? And of course, any other trends if you have picked up from the F&O space as well in terms of retail participation?
F&O retail participation, if you look at this is March 23, it is to 3.2 million. So which is constantly, growing from derivative point of view. Cash we've already seen, the markets have seen a significant decline on retail participation. But F&O participation, there is a strong, growth, and it is growing. So which was 31.5%, which was the market share, retail market share in derivative, has grown to 35.6% market share in overall market share. So which has taken it to 40 lakh crore to 87 lakh crore, which is over 115% growth. But what we need to understand is why people are trading in derivative, why option. So when you look at, you buy one Nifty contract in future, you end up buying a 1 lakh, future or cash for that matter. You have to have either 100% of the margins in cash, and future is close to 1 lakh rupees of margin for a current Nifty value. But The same thing if you want to buy in the money, at the money call, you only require 2,000 rupees close to margin, which is 2% of the total value, which is very, for retail point of view, which is not a very big number. So that encourage people to take positions into derivative, especially into, options.
Sandeep,
So I personally see that this is continue to grow.
But I'm sure from your standpoint, you'd love to see this grow. But I'm just wondering, I go back to SEBI's study. Remember at the start of the year, SEBI came out with a study that 90% of active traders have actually lost money in the futures and options market in 2022. I'm sure SEBI is also noticing and watching these trends. So would you expect regulatory action? Retail's getting active in not futures but options because margins are lower there.
It's largely options.
It's largely options. Yeah. So do you think there'll be action from the regulator?
I think regulator in last 2 years have taken a lot more action in terms of building up peak margins. So there is a uniformity, and brokers don't give excessive margins to people without adequate position, without having adequate margins. So by this peak margin regulation has already played a significant role. But in spite of that, we are noticing the constant growth in derivative turnover. And that largely happens because your invested surplus, where over the invested surplus, as I already explained you, for buying a 1 Nifty at the money call, you need to only have margin of 2,000 rupees. And even if you earn 500 rupees over it, which becomes a 25% gain, which against you, take it on a future, which becomes a less than a 1%, or in terms of cash, your surplus amount is very high. So that discourage people to, maybe participate in cash or maybe future to some extent. And options becomes a direct beneficiary for that.
Well, let's see if the regulator intends to change that a little bit. Exactly, because as you said, you need to put a margin of 2,000 rupees and you can, trade in options on that. Very interesting trend, Sandeep, and thank you for joining in and expanding, of course, the data points that we were looking at. Good talking to you. Thanks for being with us.